Chipmakers tumble in just one more challenge for US markets. Welcome to Market Insight, I'm David Pollard. Earnings, the consumer, and Trump. It's been a powerful mashup of themes for investors in recent days. With the last on that list, Donald Trump rattling chip stocks around the globe today with remarks where he questioned US support for Taiwan, home to chipmakers including the mighty TSMC. Well, joining me now to discuss those themes is Randy Watt, Senior Portfolio Manager at O'Neill Global Advisors. Welcome, Randy. So chipmakers down around 4% pre-market today on those remarks from Donald Trump and on fears of tighter US curbs on tech sales to China. How vulnerable is the sector to all these threats, and how do they play against the notion that a Trump administration would be good for corporates?
Well, the chip sector really is getting it from both the left and the right today. As you mentioned, the Biden administration kind of trial ballooned a concept of tighter tech sales to China. I think the focus there is really to trying to restrict China's advancement in AI, but that's obviously hit them. With regards to Trump and Taiwan, I think what he's doing there is really what he did with NATO, and what he's saying is Taiwan has got to pay more for the U.S. defense of Taiwan. But that's really just adding on to the Biden news. I would say, the SOX, which is the chip ETF, is up about 36% year to date. They've been very strong stocks. They've been the leaders in the market. So I think really investors, particularly institutional investors, are looking for a reason to take profits here. And this is kind of giving them that excuse as they really rotate that money into other areas of the market.
Let's move on to earnings news, which has been dominated by US banks. Morgan Stanley joined Bank of America, JP Morgan and others in reporting higher investment banking revenues. Is that the main reason to like the big money centers, and where does it leave the smaller players like US Bancorp, whose profits are down today on higher deposit costs?
Well, I would say two things regarding the big banks. First, the market has started to speculate what it would mean if Trump was to win the presidential election, if there was a GOP sweep. If there is, one thing that market participants are starting to talk about is this would likely result in less regulation and a much easier FTC. That could really set off a wave of M&A and investment banking. And indeed, investment banking was better in the quarter for the money centers, but it's possible if we get less regulation, there could be a large wave of it, and the big banks would benefit the most. The other thing that really helped the big banks in the quarter that was a surprise to Wall Street is that trading, both fixed income, but particularly equity, was better than expected. So there's a variety of things that are happening on the non-sort of basic banking side for the money centers that are doing well. With regards to the regionals, what the regionals are really focused on right now, I would say, is three things. The first is their net interest margins, which have been pretty tight recently because with high rates, they've had to pay a higher deposit cost to keep money in the banks. As rates come down, they shouldn't have to pay as much for those deposits, and that means their margins should widen. People are also really focused on credit quality, particularly in the CRE space. That is one area that on a local bank basis, people are very focused on, and that commercial real estate, particularly office, is still very weak in the US. And then finally, loan growth, which has been pretty muted. I think investors are hopeful that as rates drop, loan growth and economic activity overall can pick up, and that would really benefit the regionals more than the money centers.
Okay, well, Netflix is likely to be the next big earnings story. They report on Thursday. The success there seems to be its ad-supported subscription service, which has seen a roughly tenfold increase in subscribers in just 1 year to 40 million or so. Do you expect big things from Netflix, and will they set the tone for other big cap stocks?
Netflix has been a great stock this year. I think it's the third or fourth best of the Magnificent Seven this year, so obviously it's had great price performance. We do think this is going to be a good quarter for Netflix. And as you mentioned, what's really been driving a lot of the subscription additions has been this new ad-supported tier for $6.99 a month. Right now, about 40% of the new subs are coming into that ad tier. And that makes sense given how, especially in the US, there's really pressure on consumer spending. That's also led to a real pickup in advertising revenue for Netflix. Consensus numbers look like Netflix could do as much as maybe $3 billion in advertising sales this year. So we do think it's going to be a strong quarter. The only thing I would caution is it's been such a good stock. I'm not sure if the results will be strong enough to really satisfy the highest expectations on Wall Street. But Netflix does continue to really differentiate itself from the other streamers, and it's dramatically more profitable in that area everyone else is trying to catch up. So long term, we continue to like the stock.
Well, you were talking about consumer spending there. Let's look at the economy more widely, where US retail sales data this week was better than expected, and Amazon Prime Day sales are expected to hit a record $14 billion or more. Is the consumer, in fact, more resilient than investors feared?
Really, the story with the consumer and consumer spending is jobs. As long as the labor market can stay tight and employment can stay good, we expect consumer spending to hang in there. Now, consumers are being much more careful about what they're spending their money on, and they've really cut back from more luxury purchases to more basic necessities, and they're much more price conscious. We're hearing that from a variety of the consumer companies that we talk to. But as long as labor is okay, and remember, unemployment in the US is only about 4% right now. So as long as it can stay low, we think consumer spending can hang in there. The real risk is if there's a slowdown later in the year in jobs.
Okay, Randy Watts, Senior Portfolio Manager at O'Neill Global Advisors. Many thanks for sharing your thoughts with us today. That is Market Insight. We have more videos on Reuters.com.